Today I'm going to show you the scalping strategy that only requires first 90 minutes of trading session to execute. It's so simple to execute and it's going to bring you consistent results in the market, which I'm about to show you right now how they look like. So you can see right here, it's literally making me consistent 20k months. You can see month before, and you can see even this month it's almost 20k only a week in the month. So I can even refresh this Tradezella page if you want to see that. And the other thing, if you want to look at basically all the trades I execute, every single live session, trade recap of every single day in the market, you can go to this channel, which I'm by the way going to leave down there. So after this video you can go down there and check out all of my executions. Alright, so the first question is going to be, why first 90 minutes of trading session? So it's just going to be the most efficient time zone. So the price is just going to move as efficient as possible. It's going to be so clear for us so we can catch clean trades. Also, it's going to be aligned with all of the banks, institutions, you know, like big boys who are actually moving the market. So in the first 90 minutes of the session, they are just going to be most involved in the market. They are going to make the cleanest moves, the cleanest manipulations, which we are going to take advantage of. That is just going to be easy price action to read, because if we come every single day at the same time to the same market, we are always going to have really clean and repeatable results, which is because we are going to be in the price action that we see every single day, and it's the first 90 minutes of trading day. Then of course the last thing, we do not want to 9 to 5 the chart. So we want to trade to achieve freedom, not to 9 to 5 the chart. So that's the whole point. And why I like this scalping strategy so much is because it only requires two stupidly simple concepts that it's literally fair value gap. Like I'm going to explain you right now what these two are. So a fair value gap is just a imbalance in the market. So you can see we need 3 candles to create fair value gap. And the middle one is going to have the biggest displacement, so it's going to be the biggest kind of push of all of them, and we are going to see this kind of hole in between them, so it's just going to be called an imbalance or a fair value gap. So that's going to be the first concept that we need for this strategy. The second one is going to be liquidity. So all liquidity is in the market is just highs and lows. So a most obvious high is liquidity and most obvious low in the market is liquidity. Also, the bigger the high, bigger the liquidity point. And what liquidity actually truly is let's say if some kind of institution or a big bank wants to buy into the market, they cannot just press the buy on their keyboard, because in the end they just wouldn't get filled, because they want to enter with billions of dollars and who knows how much. But if they want to buy the market, they need to first bring the market somewhere where a lot of people are willing to sell the market. So for example, they need to push markets to the downside. So right here, a lot of people at this low are going to be selling. For example, a lot of their stop losses are going to get triggered right here at this low. So for the big institutions and banks, it is going to be the perfect spot to get into the market, because if they want to massively buy the market, everybody is going to sell to them. So here, when they actually manipulate the market to some kind of liquidity, which is high or low in the market, they can then massively buy into the market, because in the market there is going to be opposite kind of orders. If they want to buy, there's going to be huge amount of people selling. So it's actually pretty simple concept in the end, but it's very important for us because we always need to see some kind of manipulation before we enter the market. So let me show you actually what are we going to look for on the chart. Okay, so here we are at an actual live market. So let me right now show you how to easily look between these two concepts and how to find them on the chart. So the first thing that we told is going to be fair value gaps. So they are going to be very easy to spot, and we are going to actually use them for the entry part of this strategy. So the first thing that we want to do is we want to find fair value gaps or imbalances above or below the price. So if you look right here below the price, so this is the price right now is right here. If we want to look for imbalance below, this is going to be one of the imbalances below. So if you want to continue to look for some imbalances, this is going to be another imbalance below the price right now. And we also have this one down here, huge one. So these are going to be important for us because they are just the closest to the price point right now. Also, above the current price, we are going to have this fair value gap right here, which actually price heavily retested and kind of disrespected, I would say. So if you were to look at this fair value gap or imbalance as something that is going to push market towards the downside, market kind of already disrespected it because we actually closed with a body on top of it. So we really kind of disrespected it because we always want to see market doing this. So market coming down and retesting the fair value gap and pushing away from it. Same as right here, market came to it, respected it, pushed away from it. So that's what the fair value gaps are going to be for in the first step. So we are always going to need to look that the market actually comes to it and rejects from it. And now the second thing which I told you guys is liquidity. So now that we know that fair value gaps are these ones right here, because we don't have any fair value gaps higher than the price is right now really. So if we want to look for some kind of longs, we need to spot some kind of liquidity to the downside. So if we mark out the market structure, which is basically just push to the upside, then a pullback, and then we have another push to the upside and a pullback, another push to the upside, pullback, and another push to the upside. So this is going to be, let's say, our market structure right here. So what do we want to do? We want to mark out each low in the market. So this is going to be our low, then this is going to be our low right here, and then this is going to be our last low in the market. So if you want to see some kind of trade towards the upside, so if you want to long the market from here, we want to see some kind of liquidity get manipulated. So some kind of low needs to be swept for us to actually enter into buy positions. So when we basically marked out all of the fair value gaps and all the liquidity to the downside, we go to the lower time frame, which is going to be 1 minute time frame, and we just wait for us to actually sweep liquidity and tap into the fair value gap. So let's see what liquidity and what fair value gap is that gonna be. So we actually tapped into the fair value gap all the way down here, if you remember the bottom one that we marked out, and we swept all the liquidity. So I'm gonna move these out of the way so they don't bother us, and I'm gonna move this fair value gap. And what do we have to look for now? So now all we need to see in the market is a last fair value gap that happened. So this is a fair value gap in the market that happened last in this leg. We want to see that fair value gap getting disrespected, because the logic behind that is on the 50-minute time frame. If this fair value gap that we marked out, that is like this right here, is going to get respected, so respected to the upside, and this fair value gap right here that needs to push market to the downside is going to get disrespected to the upside like this, price clearly does not want to go anymore to the downside, and it's very likely to continue going to the upside, and it's very likely to continue to the upside till some kind of liquidity higher or a fair value gap above the price right now. So what we have to wait for right now is an actual closure of the body above this fair value gap, and let's see, this was almost closure above, and there it is. So if we get a closure actually like this above with the body above the fair value gap, all we do is enter the market and put our stop loss right below the fair value gap, and we target some sort of liquidity towards the upside. So let's say this liquidity right here. As I told you guys, price is always going to seek some kind of liquidity, and if we check out, this is the price movement that we had right here. So we have to target some kind of these highs up here in the market. So let's actually see how the market is going to play out. Is it going to go to the TP or stop loss? And there it is, actually got the full TP. You can see market even got all of these guys right here for a total of 3 risk to reward. And I always like to tell you guys that if you have $100,000 in prop firm capital, which is so easy to achieve these days, if you would to have this win and risk 1%, this would actually be $3,000. So just imagine scaling up to like $1 million in capital or something like that. Like, these wins can actually be so insane. Okay, so here we are at the second example, and this one is going to be a little bit more interesting because I put in something bonus for you guys. You're going to see how you guys can even profit more on trades like this. But before we actually go with it, if you like the video and if you found it helpful, just leave a like, subscribe and comment. That's just going to make my newest videos come up to you on your homepage so you can view all of them. So let's just begin with it. So the first thing, of course, as I told you guys, is on the 50-minute time frame, we want to look for the fair value gaps or the imbalances. So if you look in the market right now, you can see this is an imbalance towards the downside, and if we look to the left, there is no structure at all. So all we can look for right now is for some kind of longs. The second step for us is to mark out all the liquidity in the market, and if we look at the market, what it has done recently, we can see that we basically made a push and then a retrace, another push, little retrace, and then another push. So if we want to mark out liquidity, that's going to be this one for sure. And now all we do is go to the lower time frame, which is going to be 1 minute time frame, and just wait for the sweep and the retest of the fair value gap. Okay, so let's see if the market is going to sweep it, and there it is, the sweep of this low. So all we do right now is we have to wait for the market to actually inverse the last fair value gap. But here is a little catch. We always want to check out, since we are on the 1 minute time frame, we want to check out 2 minute and 3 minute time frame before we actually enter the market, because there also might be some kind of fair value gaps. And if we check out, you can see we have one fair value gap right here. And if I scale this out, we can wait for the closure of this fair value gap right here. So let's see if we do get it or not. So looks like the market is going to go to the upside, but is it going to close above? And we actually created new fair value gap. So I'm going to move this one out of the way, and I'm going to place a new fair value gap right here. So we always have to look for the newest fair value gap in the market, and let's see if this one is going to get disrespected. And there it is. So we got a closure above, we put our stop loss just below it, and we target some kind of high to the upside. It's not important as long as it's like liquidity like this one or like this one. And what do we do next? We basically just wait for the trade to play out. But I'm quickly going to show you how we can profit even more on some kind of re-entry. So if you look to the market right now, we see that market, we are basically in a trade right now, and we see that market came down, retested this fair value gap, and you can see the rejection on it. So if we go again to the lower time frame, which is going to be 1 minute time frame, as you can see, we see that we formed a new fair value gap towards the downside. So if we actually inverse this fair value gap, we can add to our position. So we can enter another position to the upside. So basically like this, and we enter another position. So now we are running two positions like this. We can target the same take profit, and let's see how are they basically going to play out to the upside. So let's see, and it's slowly going to the upside. And is it going to actually hit our TP? And there it is. So actually right here it hit our TP of our both positions. So one is 2 risk to reward, another one is also 2 risk to reward. So in total of 4 risk to reward, and basically for a $100,000 funded account, this would be $40,000. And also, before you guys leave the video, I'm gonna actually give you something for completely free, which is a playbook of this strategy. So if you want to claim a 10-page playbook, all you have to do is go down there to the description and just literally claim it for completely free. And also, if you like the video and you want to just see more of those, just like and subscribe. Also ask anything in the comment you want. And also, if you maybe want to get mentored by me one-on-one, you have a link down there to basically book a call and check if you're a right fit for the mentorship. So if you want to do that, do that. And basically, with all of that being said, I'm gonna see you in the next video. Peace.